Dear lovely students, welcome to my macroeconomic courses. My name is Dr. Jafar Jafarov from Azerbaijan, and today we are going to conduct a presentation about the inflation and deflation. And this is a nice lecture. And today we are going to talk about the inflation, deflation, the causes of inflation, and the inflation rate and the how to minimize the inflation rates. We will know about the types of inflation and the economic impacts of inflation, and we will understand what is a deflation and what causes the deflation and etc. Okay, let's start with the inflation. Dear students, inflation is defined as a sustained increase in the general level of prices for goods and the services in a country. In economics, inflation, in generally, it is a rise level of prices of goods and the services in an economy over a period of time, and it's measured as annual percentage change. Under the conditions of inflation, the prices of things rise over the time. If we are talking it differently, as inflation rises, every month, every dollar, every euro you own buys a smaller percentage of good and the service. When the prices rise, and alternatively, when the value of money falls, you have the inflation. The value of dollar or any unit of money is expressed in terms of its purchasing power, which is the amount of real tangible goods or actual services that money can buy at a moment in time. When the inflation goes up, there is a decline in the purchasing power of money. For example, if the inflation rate is 2% annually, then theoretically a dollar pack of gum or a dollar pack of pencil will cost $1.02 in a year. After the inflation, your dollar or your manat doesn't go as far as it did in the past. This why a pack of gum cost just $0.05 in 1940s. The price has risen, or from a different perspective, the value of dollar has declined. In recent years, nowadays, in modern times, most developed countries have attempted to sustain an inflation rate of 2 or 3% by using the monetary policy tools. As we discussed, maybe you remember, lovely students, in our previous classes we discussed about fiscal and the monetary policy. So if these inflation rates are using the monetary use the are regulated by the using of monetary policy tools, which is controlled by central banks. This general form of monetary policy is known as inflation targeting. So, a chief measure of price inflation is the inflation rate, which is a percentage change in a price index over the time. When the general prices level rises, that each unit of currency buys goods and services. Economists generally agree that high rates of inflation and hyperinflation are caused by an excessive growth of money supply in the turnover. If we are come to the conclusion with the inflation rates formula, we can see in the slide that the rate of inflation is equal to price levels, for example, in 2020 minus to price levels in the previous year, price level 2019. We divided the 2019 the price levels and multiply the 100 percentage. So what we understand the rate of inflation. We come to the conclusion how to calculate the rate of inflation in a given of time. So inflation is usually measured by calculating the inflation rate of price index, usually the consumer price index. Yeah, usually consumer price index. The consumer price index measures the prices of a selection of goods and services which is purchased by a typical consumers. The As we discussed already, the inflation rate is a percentage rate of change in the price index over the time. Um, for example, let's talk in Azerbaijan. In January, I found this information from the Statistical Commit of Republic of Azerbaijan. In January 2020, compared to January 2019, the consumer price index was 2.7 percentage. So how do we find this percent this rate? So first I get the consumer price index 2020, then I find the 2019, then I get the minus from 2019 and 2020 and 2019, then divided previous year to 2019, and then I found that price level, how much the price level increased. So we found that at the moment, 2.7 percentage price level increased in Azerbaijan. Um, how this inflation affects on the economy? Is it good or is it bad? It has a positive or negative effects. How does it affect on the economy? Actually, inflation can cause the adverse effects on the economy. Imagine that you are an investor. You want to invest your money. You want to make the savings to put your all your money deposits in the banks, and you first need to think about that, how this inflation affects if it will affect on your investment or your savings. For example, uncertainty about the future inflation may discourage your investment and savings. Inflation may widen an income gap between those fixed incomes and variable incomes. High inflation may lead to shortage of goods as consumers begin hoarding them out of concern their prices will increase in the future. Yeah. And sometimes the students are mixing the deflation disinflation, and actually these are the different approach. Deflation occurs when the general level of prices is falling down. Deflation have been rare in late 20th century, and disinflation is donates a decline in the rate of inflation. Yeah? And economists, academicians, or um, researchers are trying to minimize the inflation rate, but how we can do it? How the government can minimize the inflation rate? The task of keeping the rate of inflation is using the monetary policy by the monetary authorities. Generally, at the moment, these monetary authorities are the central banks. In Azerbaijan, this monetary policy are controlled by the Central Bank of the Republic of Azerbaijan, which is controlling the size of money supply through the setting of interest rates, through open market operations, and through the setting of banking reserve requirements. So, uh, like this is, inflations also exhibit the different levels of severity, which is classified into three categories. These are, the types of inflation, or different strains of inflation, or different categories of inflation. We are dividing into three. In our lecture, we divided into four places. Like we divided that soft or creeping inflation, but in other literature that is used that low inflation. Then we divided galloping inflation and hyperinflation. Don't mix, students. In our lecture, like in a text, uh, I was written the soft or creeping inflation, but here I put together and made the low inflation because I want to explain you clearly, and that's because when you read out, when you check your lecture, don't mix it. Okay, so it is three or four categories: low inflation, or in other name, the soft or creeping inflation, galloping inflation, and hyperinflation. What is low inflation? Okay, so let's first inflation when the prices of goods and the services increase. Yeah, we understood like that. As I explained that there are the four main types of inflation categorized by their speed. Yeah, these are making the speed low, galloping, and the hyper, like a straight line. They are creeping. Creeping, it means the very low, very small, very not quickly. It's kind of a lazy one, lazy line. Cannot not so much fast. And Volking, it's I always thinking about this inflation line as a cute baby. Yeah, and you are born, and then you are walking, then you are going to school, and then you are going to die. And creeping inflation, you are boring. This is a soft, kind of a soft one. And walking inflation, galloping inflation, and hyperinflation. These are the specific types of asset inflation and also the wage inflation. Some experts say demand pull and the cost push inflations are two more types, but I will explain you later in our presentation, but don't want to talk more now. But they are the causes of inflation as well. So the expansion of the money supply. Um, let's see that the low inflation. Yeah, low inflation, it's characterized by the prices that rise slowly, not faster, and it's a predictably, and it's defined as single digit annual inflation rates. Prices are relatively stable. People trust money. Why people trust money? Because it retains the value from month to month or year to year. People are willing to write the long-term contracts, negotiations in money terms, because they are confident that relative prices of goods they buy or they sell will not get too far out of line. And this is the low inflation. In other ways, when the prices in some literature you can find out that when the prices rise to 3% a year or less, that is also called the low inflation, or mild inflation, or creeping inflation. According to the United States Federal Reserve, when the prices increase 2% or less, it benefits the economic growth. This kind of mild inflation makes the consumers expect that prices will keep going up. That puts the demand. Consumers buy now to beat the higher future prices. Yeah, we I explained you, if you remember that I explained you aggregate demand and aggregate supply classes. That's how the mild inflation drives the economic expansion. For that reason, the Federal Reserve sets a 2% as its target inflation rate. And second one is before the galloping inflation, let me talk a little bit about the walking inflation. This type of strong or strong or pernicious inflation is between approximately 3-10% a year. It is harmful to the economy because it heats up economic growth too fast. People start to buy more now than they need, just to avoid the tomorrow's much higher prices. Imagine that all the stores are declaring that the prices of TV or prices of electronics will be go up in the next month, and then you go to the stores and buy more than you need, and this drives the demand even the further, so that suppliers cannot keep up, and more important, neither can wages. As a result, common goods and the services are priced out of the reach of most people. Yeah, and galloping inflation. And when the inflation is rising to 10 percentage or above, this inflation is double digit or triple digit range of 20, 100 or 20 per year is called. This is a galloping inflation or very high inflation. It's relatively common in countries suffering from weak governments, war conditions, or evolution. For example, this many Latin American countries like Argentina, Chile, Brazil, they had the 50 to 700 percentage per year in 19th century or into 1970 or 1980 years, when the inflation is more than the 10%, 20%, 50%. Money loses value so fast that businesses and employee income cannot keep up with the costs and the prices. Foreign investors avoid the country. They leave the country, depriving it needed the capital. The economy becomes unstable, and the government leaders lose their credibility. Galloping inflation must be prevented at all the costs. Yeah, and next one is also um, um, hyperinflation. What happened in this inflation? Once the country enters in galloping inflation, serious economic distortions arise. Most contracts get indexed to a price index of foreign currency like the US dollars. Money loses its value very quickly. People hold only the bare minimum amount of money needed for daily transactions. Financial markets wither away. Capital flees abroad. So financial markets wither away. People hoard goods, buy houses, and they never lend money at low nominal interest rates. Hyperinflation is when the prices of goods and the services rise more than the in some literatures is written the more than the 100 percentage or 200 percentage per a month, or 50% percent a month. The severity of price increases distinguishes it from the other types of inflation. In this inflation, prices rise 10% or more a year, or maybe 100% a year. Hyperinflation starts when a country government begins the printing money to pay for spendings. As the money supply increases in the turnover, prices rise as in regular inflation. A sort of deadly strain takes when the hyperinflation strikes. Nothing good can be said about the market economy. Prices are rising a million times or even the trillion% per year. Or if you remember in the Weimar Republic of Germany in 1920 years, the price levels was rising up from 1 to 10 billion. Uh, Guys, um, before starting the inflation, defining the index, I want to explain about the anticipated and unanticipated inflation. Of course, if we know that the prices will go up in the next year, we can use some anticipated or how can I say recovery to concepts, and from this line, we can divide into anticipated and unanticipated inflation. Anticipated is expected rate of inflation. We can forecast some regulatories. We can use some mechanisms in order to decrease this level. And inflation at low rates has little effect on economic efficiency or distribution of income and wealth. People would simply be adapting their behaviors to changing the monetary yardstick. So unanticipated inflation is this is more than the expected inflation rates, and like in the United States, the impact of unanticipated inflation is less dramatic. Unexpected jump in prices will improve some and enrich the others. And this situation will make the redistribution of wealth, and the effects may be more social than the economic types. And um, we talked about the causes of inflation and how to minimize it, and let's see the economic impacts of inflation. How does it affect? Inflation affects the distribution of income. Yeah, inflation affects the distribution of income and wealth as well because of differences in the assets and the liabilities. When the people owe the money, a sharp rise in prices is a windfall gain for them. Suppose that you borrow that $100,000 or 100,000 manat to buy a house or annual fixed interest mortgage. Payments are $10,000, 10,000 manat. If a great inflation doubles so wages and incomes, your nominal mortgage payment is still the $10,000 per year. But its real cost is halved. You need to work only the half to make your payments. Inflation has increased your wealth. And other economic impacts of inflation, if you are a lender and you have the assets in fixed interest rate mortgage or long-term bonds, the unexpected rise in price will leave you to poorer because the dollars repaid you are worth much less than the dollars you lent. The major redistributive impact of inflation comes through its effect on the real value of people's wealth. Unanticipated inflation redistributes wealth from the creditors to debitors. Yeah, and the impacts of economic efficiency is the redistribution of incomes. Inflation affects the real economy into two specific areas. It can harm economic efficiency and it can affect the total output. Yeah, and so guys, in here I want to explain a little bit about um, as I mentioned you, the demand pull and the cost push, causes of inflation. Okay, so let me explain a little bit about inflation defining index. An inflation index is what is an inflation index? It's an economic tool. It is used to measure the rate of inflation in an economy. And there are several different ways, okay? There are several different ways to measure the inflation, lending to more than one inflation index, with different economists and investors preferring one method to another one, sometimes the strongly one. And this brief overview should help you understand how the inflation index works. Some of the more popular models and perhaps even help you decide for yourself and one you think represents the true inflation rate. And this inflation defining index are the three one, the majors one: Las Peras index, Paische index, and the Fisher index. Las Peras index, proposed by German economist Las Peras, for measuring the current prices of or quantities in relation to those of selected base period. Las Peras price index is computed by taking the ratio of the total cost of purchasing a specific group of commodities at current prices to the cost of that same group at base period prices, and multiplying by 100. The base period index number is that's 101, and the periods is a higher price level have index number greater than 100 percentage. And Las Vegas price index tends to overstate price increases because as price change, consumers typically alter their purchasing decisions by selecting the fewer products with large price increase, while buying more products than show low or no price increase. If the consumers can do this without reducing their total satisfaction, the use of base period commodity selections tends to overstate declines in the standard of living. Second one is similar to the price index. The Las Vegas Quanta Index use the base period prices to compare the aggregate production levels in two periods. A second one index is a Paische index. This index developed by German economist Hermann Paische for measuring the current price or quantity levels relative to those of selected base period. It differs from the Las Vegas index in that it uses the current period weighting. The index is a ratio that compares the total purchase cost of specified bundle of current period commodities. The Paische price index tends to understate price increases since it already reflects some of the change in consumption patterns that occur when the prices respond to price increases. Example, the increased consumption of goods will indicate the reduced relative prices. The third one is the Fisher Price Index. It's an index formula used in price statistics for measuring the price development of goods and the services on the basis of baskets from the both base and current period. It is defined as a geometric average of the Las Vegas Price Index and Paische Price Index. For this reason, the Fisher Price Index. This is I forgot to talk about the American economy. This is named after American economist. The Fisher is also known as the Ideal Price Index. And guys, as we discussed beforehand, that causes of inflation have divided into some inflations come from demand sides and the other inflation why? Because if you have some difficulties, for example, this is just an example from personal life. If you have that some financial difficulties, you are looking at why you have the financial difficulties. Maybe your cost is rising up or your income is decreased, and so if there is an inflation, we need to identify that these inflations come from demand side or supply side. Yeah, demand pull inflation or cost pull inflation. Inflation. Demand pull inflation occurs when the aggregate demand rises more rapidly than the economy's productive potential, pulling prices up to equilibrate aggregate supply and demand. Demand pull inflation is caused by an overall increase in demand for goods and the services, which beats up their prices. This theory can be summarized as too much money chasing too few goods. In other words, if demand is growing faster than the supply, prices will increase. This usually occurs in rapidly growing economies. This theory is often promoted by the Keynesian schools of economists. One important factor behind the demand pull inflation is rapid money supply growth. Increase in the money supply increase aggregate demand, which is turn increase the price level. Cost push inflation. This inflation resulting from the rising the costs during the periods of high unemployment and the slack resources utilization is called the cost push inflation. Inflation is caused when the company's cost of production go up. When this happens, they need to increase the prices to maintain their profit margins. Increased costs can include the things such as wages, taxes, or increased cost of natural resources, or either imports. Yeah, and um, monetary inflation monetary if before going to deflation, monetary inflation is caused by an oversupply of money in the economy. Just like any other commodity, the prices of things are determined by their supply, yeah, by the supply and demand. There is too much supply. If there is a too much supply, the price of that things goes down. uh, if that thing is money and too much supply of money makes its value go down. The result, like if you go to Iran, you see that you just paid 100 manat, and instead of 100 manat you get the box of one packet of one box of one bag of money. So this means that if that too much supply of money makes its value go down, the result is that the prices of everything, like Venezuela, like other countries, if there is a much money in the turnover, that is making the conditions for losing the value of money. So the result is that the prices of everything else priced in dollars must go up. This theory is often promoted by the monetary school of economists. Inflation affects this different people in different ways. It's not always affecting to the people negatively. Sometimes the people are affecting, sometimes people are benefiting from the inflation, with some benefiting from its effects at the expense of some who lose out. It also depends on the whether the changes to the rate of inflation are as we discussed before, unanticipated and unanticipated. If the inflation rate corresponds to what the majority of people are expecting, anticipated inflation, then we can compensate, and its impact is not necessarily as severe. For example, banks can vary their interest rates, and the workers can negotiate contracts that include automatic wage hikes as prices go up. Um, I want to just give a brief account of typical winners and the losers from the inflation. Imagine that creditors, like lenders, lose, and debitors, like borrowers, gain under the inflation. For example, suppose a bank issues you a 30-year mortgage, which we call it hypothec credits, a mortgage to buy a house at a fixed rate of a 5% per year, costing the $100 manat per month. As inflation rises, the cost of this $100 manat per month decrease, which benefits the homeowner, especially if the rate of inflation exceeds the interest rates on the loan. Inflation hurts the savers, since a dollar or manat saved will be worth less in the future, unless the money is saved in an account that pays an interest rate at above the rate of inflation. The purchasing power of savings will erode. This phenomenon is sometimes called the cash drag. Workers with fixed salaries or contracts that do not adjust with the inflation will be hurt as the buying power of their incomes stay the same relative to rising prices. Similarly, people living of a fixed income, such as those below the poverty line, retirees or annuitants, see a decline in their purchasing power. Consequently, as a result, their standard of living. Landlords benefit if they have a fixed mortgage or no mortgage, as they are able to raise the rent more each year. Uncertainty about what will happen the next makes the corporations and the consumers less likely to spend. This hurts economic output in the long run. So deflation is when the general level of prices are falling. It is opposite effect of inflation. And when the prices are declining over the time, deflation tends to occur more rarely and for shorter periods of time than inflation. Deflation occurs typically during the times of recessions or economic crises, and it can lead to deep economic crises, including depression. The reason for this is called the deflationary spiral. When the prices are going down, why would you spend more money today when each dollar, each manat will be more valuable tomorrow? And why spend tomorrow when each dollar can buy, each money can buy more the day after? The result is that people stop spending and hoard their money in anticipation of prices falling even further. If money is being hoarded, it's not being spent. So business profits collapse and the people are laid off. Increasing unemployment leaves the economy with even less spending and spiral continues. I don't know this inflation in here. Let me show you this inflation. Okay, let me tell you also this about the disinflation. This inflation um, is a condition where the inflation is still positive, but the rate of inflation is decreasing. For example, from 3% to 2%, or 5% to 4%. Okay, so in common use, deflation is generally considered to be falling prices. As I discussed, Great Depression years, deflation is a decline in general price level, often caused by a reduction in the supply of credit money. So, what causes the deflation? Deflation can occur because why the deflations occurs? Because of combination of four factors. First, the supply of money goes down, demand for money goes up, supply of other goods goes up, demand for other goods goes down. These four factors, the combination of these four factors occurs. They occurs. Not occurs causes for creation of deflation. So deflation generally occurs when the supply of goods rises faster than the supply of money. Okay, guys. As I talked inflation, stagflation. What is stagflation? Stagflation is a rare combination of high unemployment and economic stagnation, along with high rates of inflation. Um, when this happened in industrialized countries during the 1970 years, when a rocky economy was confronted with OPEC raising the oil prices, resulting in a demand shock for oil. This sent the price of oil and all of the products and services that use oil as an input higher, even the economy slackened. People often complain when prices go up, but they often ignore the fact that wage should be rising as well. The question should not be whether inflation is rising, but whether it's rising at a quicker pace than their wages. A modest inflation is a sign that an economy is growing. In some situations, in some conditions, little inflations can be just as bad as high inflation. The lack of inflation may be an indication that the economy is weakening. As you can see, it is not so easy to label inflation as either good or bad. It depends on the overall economy as well as your personal situation. Okay, guys. Um, Inflation is good or bad? Sometimes the people are asking questions. Okay, if there is an inflation in blah blah country, it's bad or it's good. What happens if the quantity of goods available increase? What if instead of having the 10 items, we build 10 more? We now have 20 items and only $10. So once again, each item is worth 51. Um, Deflation is good or bad? This form of deflation is good type because if prices go down, because the goods can be manufactured more cheaply, and this end up increasing the everyone's wealth. Everyone assumes the deflation is bad because the last major deflation that we had was during the Great Depression. So, deflation and the depression are synonyms in many people's mind. Actually, deflation itself is neither good or not bad. It depends on the cause of deflation, whether the people will suffer or rejoice. If the prices go down, due to increasing supply of goods because of lower cost of production, while the supply of money remains the constant. It's good. An example of this is late in the 18th century, as the industrial revolution dramatically increased productivity. Yeah, and so guys, um, we talked about that stagflation already. Yeah, we aggregate supply shocks. So, what caused the stagflation of 19th and early 19th century? A series of cost shock or aggregate supply shock caused the stagflation in these years. A series of supply shocks, including the sharply increased energy costs, higher agricultural commodity prices, higher input prices, diminishing productivity growth, and inflationary expectations shift the aggregate supply curve the upward. And that was that if you look at the cost push inflation model, a decreased aggregate supply causes unemployment rate and the price level to vary directly. The result of aggregate supply shock stagflation, a higher price level accompanied by a decline in real domestic product. So, guys, we talked about. Let me just make a conclusion. We talked about that determination of inflation. What is inflation or deflation, stagflation, and types of inflation. We talked about that low inflation, galloping inflation, hyperinflation. We talked about the monetary inflation. We talked about the cost of inflation. So we talked about that deflation. We talked about that inflation defining index, Las Peras index, Pacha index, Fisher index, and now I want to explain about that monetary and non-monetary inflation. Monetary inflation is sustained increase in the money supply of a country or a currency area, depending on many factors, especially the public expectations, the fundamental state and development of the economy, transmission mechanism. It's likely to result in price inflation, which is usually just called the inflation, which is a rise in the general level of prices of goods and services. There is a general agreement among the economists, but there is a causal relationship between the monetary inflation and the price inflation. But there is neither a common view about the exact theoretical mechanisms and relationships, nor about how to accurately measure it. This relationship is also constantly changing with a larger complex economic system. So there is a great deal of debate on the issues involved, such as how to measure the monetary base and the price inflation, how to measure the effect of public expectations, how to judge the effect of financial innovations on the transmission mechanisms, how much the factors like the velocity of money affect the relationships. Thus, there are the different views. What would be the best targets and tools in monetary policies? So, what is the reasons for non-monetary inflation? First reason is the high population growth. High population growth making the non-monetary inflation. Yeah, monetary inflation, we understood that it's caused by the monetary sides. Non-monetary monetary inflation, about that, is not regarded to the monetary sides. First is high population growth. If the population grows, we have the population growth, so that also could be making the non-monetary inflation. So it could be also cause for inflation. So natural calamities and the bad weather conditions also could be the reasons, the causes for non-monetary inflation. Speculations and hoardings. So these are also could be the causes for non-monetary inflation. So higher prices of import. So monopolies, I mean the profits and unfair trade practice. So underutilization of resources. These could be also the main reasons and the main causes for non-monetary inflation. So, guys, I would to conclusion that inflation or bad or good or bad, it's not affecting to each countries in the same level. Some countries are affecting it positively, some countries are affecting it negatively. But in modern times, economists or academicians or researchers, they are defining that, explaining that the normal interest rates, approximately the 2 or 3 percentage, should be for the inflation of rates in a country. All right. This is all totally about that inflation. We understood how the inflation is emerged, and also we we understood what is the main causes for inflation and the types of inflation, and um, there will be more stuff to buy more before the inflation is eating up. And if so there is a real expansion, a bit of inflation can grow the economy. The argument is that doesn't matter of if the prices are going up percent every year, wages are going up 10 percentage. So a deliberate government-led inflation can be mechanism for growing, um, but it is very risky move, which is often backfired and being attacked by the great enemies of the Keynes Keynesian economists, people. And so, all right, all the lectures are. If you have any comments, or if you have any questions, lovely students, you can just forward to me, and I always welcome to answer all your questions. Thank you very much, and I hope you enjoyed the lecture. And if you have any questions, you can just forward to me. Okay.